Good day, I'm Steve Meldrum, and I'm going to be sharing with you a tax strategy that's quite a bit more advanced than our first webinar, but looking forward to it because it's a way for you to get tax deductions as well as take advantage of opportunities that you're seeing out there right now. I always like to start with this cartoon. It's one of my favorites. I'll give you a moment just to reflect on it. I did share it last time, and I want you to have creative thinking, a way to get outside of the normal and to start thinking about how you can change the game for yourself. Now, I've done a lot of speaking gigs over the time at most dental conferences, and I also have a few brother-in-laws that are in the dental field. Two are general practitioners, and one is a periodontist. So I've been able to have a lot of conversations with a lot of dentists over time, and there's a couple main themes that come through. First, they all want to save taxes now. Second, they want to save taxes in the future. And thirdly, they want to make sure that they can transfer their wealth to their kids or the causes that they care about. Now, in our first webinar, we showed this infographic at the end. I'll just touch on some aspects of it to launch us into today's strategy. First, that when a corporation earns money, it pays in Alberta a low rate of tax, 11% tax up to the first $500,000. Above that, you'd pay approximately 25% tax. Now, the challenge is if you keep your money inside the corporation, eventually you'll have too much. It's difficult to see, but that little graph is showing that if you earn more than $50,000 of passive income, which is called AAII, Adjusted Aggregate Investment Income, then the government restricts and reduces the amount of low rate tax that you can get. Now, the challenge we said is tax, so let's put the money into an insurance policy. When you put money into an insurance policy, it grows without tax. And that's a big advantage for a dentist because they're faced with tax every day on their personal income, corporate income, but an insurance policy allows you to tax shelter your money. And there's ways to eventually access that money. We're going to have a future webinar on accessing it in retirement. This infographic shows accessing it on death, and all of the money and all of the growth is able to flow out underneath the tax bridge through the capital dividend account. You can talk to your accountant about this, but it's a special account that allows you to move money tax-free from the corporation to yourself individually. Now, if we're putting money inside the insurance policy, last time we talked about dividends being created. And dividends are more than just investment returns. They come from mortality gains. They come from other factors, come from policy loans that people might take on their insurance, or if people had started it but canceled. There's a lot of things that form a dividend which the insurance company will pay to you each year. That payment each year allows your insurance policy to increase in value and increase that you can always have advantage of. Now, what's your opportunity? That's our last webinar, but what's your opportunity that you're thinking about? Is it your dental practice? Is it other investments? Is it real estate? I mean, I'm not sure, but most people, if you're entrepreneurial, have an idea that they want to pursue. So putting your money into an insurance policy can be seen as boring. However, with today's tax strategy, we're going to show you how you can double up the use of your corporate dollars. Here's an infographic of what I'm going to share today. It's a little more advanced from our initial one because now we're introducing a bank into the mix. And what we're doing is we're putting, same as last time, we're putting money into the insurance policy, but we feel there's other opportunities. So we don't want to tie up our cash. We want to keep it close at hand. So we go to a bank, and that bank will provide us money to finance a portion or all of the premium that we would put into an insurance policy. And the reasons we would do this is partly for tax deductions. When you borrow money to invest, which we're doing, if we borrow money to invest, we get to write off the interest that's paid. The going rate for these types of arrangements from a bank interest cost is about prime. We can get it lower than prime as well. So very low rates of borrowing money. So you put the money into the insurance policy, you've gone to the bank, and they're going to re-advance or recycle that money back to you. And with that money, you will pursue your opportunity. Maybe your practice, maybe the markets, maybe real estate, and you'll put it into that second pot. That second pot can grow largely tax sheltered until you sell it. When you sell it, half of it will be taxable and half of it will be non-taxable. The non-taxable portion can go through the capital dividend account, tax-free to yourself personally. So there's a perk there. And on this infographic, you'll see now the only two ways that you create a capital dividend: the non-taxable portion of a capital gain, as well as life insurance proceeds. Now, I mentioned going to a bank to getting part or all of the premium. There's three main methods of doing so. One is you can get 100% of the equity or cash value. Second, you can get just the premium itself. Or third, the premium plus a portion of the interest. We call it net interest because the bank will lend you the amount after you've written it off for taxes, any residual interest payment they would lend to you. So here's the three main funding options for this strategy. Now let's talk about some considerations. And we have the yellow light because we want you to give some thought to this. In our position, we give counsel and advice to not just our clients, but also accountants and lawyers in making these arrangements. First is considering interest rates. The bank interest rate may increase. It could go lower, but may also increase, which would then have a higher charge for each year. Second, dividend rates. The dividend rate that you've been receiving may lower. And if it lowers, then the speed at which your policy grows can also be lower than originally planned. Third, the ability to use interest deductions. I mentioned anytime you borrow money, you get to deduct the interest, but you have to be deducting it against something else, other income. So you might have other real estate income, professional income, so on and so forth. You just want to make sure you have other income to use those tax deductions. Another consideration, if you've done this strategy and for some reason you decide to quit the strategy down the road. If you're far into it and you quit, there may be a taxable situation, and that tax situation would be the equity or cash value over the adjusted cost basis, or ACB. So any amount over that would be considered taxable and put into your income that year of canceling this policy. Now, if you decide to keep the policy but cancel the loan by paying out the loan, you can also do that and you would not have any tax issues. Need to give you this visual because we'll go through the last couple considerations. One is a collateral insurance deduction. So you get an insurance, you get a deduction not just for the bank interest, but also for a portion of the insurance premium. It's called net cost of pure insurance, and that's essentially the mortality cost of your life. So that portion you're able to also write off of. However, you need to make sure that the owner and the beneficiary of the policy are the same in order to qualify for that. And secondly, it's always the lesser of premiums paid or the net cost of pure insurance. So caution, if you have a policy that's considered a 20-year policy where after 20 years you're not required to pay, then although you would have an NCPI, you would no longer be paying premiums, so you would not have that second deduction. There's also consideration for shareholder benefit issues. And this is, depending on how you structure it, upon death, you want to make sure that you have proper direction to pay procedures so that your bank loan is paid off of, your estate receives the benefit, and everyone's happy. So is there an exit? This should be a valid question. Is there an exit if I start this tax strategy? And there is, and it's not just death. Some exits are if you have a liquidity event. This could be a practice sale. This could be an investment sale, an inheritance. We've seen these different injections of large lump sums of money, and they can be used to either pay off the interest or completely pay off the loan itself. So there's some ways to exit from the financing arrangement. If you do that and pay out the loan, there's no tax consequence, and in fact, your insurance policy can continue to grow. Now I want to briefly talk about leftovers. I use the analogy of leftovers from a turkey dinner. I've never been to a turkey dinner where there isn't leftovers, and the same holds true for the capital dividend account. That is, once you've paid upon death, if you repay the bank loan, which is required, there's a portion of the money that's remaining can be paid out to you through the capital dividend account. But the capital dividend account is still created for the full value of your death benefit minus the adjusted cost base. So at life expectancy, that's usually the entire amount of the policy. And the entire amount of the policy could be larger than just the remaining money after the bank loan. So you can use other assets in the corporation, real estate, equipment, cash, investments, and you can pull it over to the personal side with no tax consequence through the capital dividend account. So just like a good turkey dinner, you're going to have some leftovers. You can make some soup, some pie, some sandwiches, and those kinds of things. I want to give an example. This was some feedback from our last webinar to provide a case study. There's quite a bit of detail here. I know it's hard to read, but I want to point out a few aspects that can happen with this type of arrangement. So in this case, we have a male 26, non-smoker. They're going to put in money for 10 years. They're putting roughly $100,000, and what they're doing is they're pulling out that money immediately. Okay. In this case, they're just getting a loan based on cash value or equity. And so you'll see in the middle column that their loan advanced is, or pardon me, they're getting the loan plus some premium paid in there. So the loan balance in the middle column will continually increase. In this case, they're just paying they're getting the loan advance each year, and it carries forward. In year 30, the bottom arrow, they decide to no longer advance money out of the insurance policy, and they can carry on. Pardon me, you want to check one thing? So if we look at this situation, he's paid for 10 years. After 10 years, no longer puts money into it. He's essentially used that money for an alternative investment and continued to take advantage of his opportunity. Here's some key factors. At life expectancy, which is represented by the arrow, LE, we can see that there's a death benefit paid. That death benefit is over $13 million. But there's a bank loan, right? So we need to pay back the bank loan, which is roughly 6.5 million. The other 6 million gets paid directly to the beneficiaries. And it can, in this case, the corporation, which will then flow to the estate through the capital dividend account. But there's still remaining capital dividend account of 6.6 million. So that means that the corporation can move other assets, real estate, investment, cash, from the corporation over to the personal estate tax-free. And that's huge. Again, here is our infographic we've shared with our tax strategy today that provides two opportunities for you to get tax deductions as well as take advantage of those opportunities that you have in your life. Our next webinar is on April 28th, 1 o'clock Mountain Standard Time. We'd love to have you. Please feel free to reach out to us. You can email, book our meeting. You can also check us out on social media. Thank you so much for your time. We appreciate you spending some moments to start thinking about alternative tax strategies. Take care and have a great day.